How to invest in stocks for beginners. Imagine waking up one morning to find that your money has grown without you having to do anything extra. Sounds like a dream, right? But that's exactly what smart investing can do over time. Now, let's be honest. Investing in stocks can feel overwhelming at first. Where do you start? How do you know which stocks to pick? What if you lose money? These are common fears, and guess what? Everyone has them in the beginning. But the truth is, investing doesn't have to be complicated. In this video, we're going to break it all down, step by step. Stay tuned until the end to learn how to start investing, even if you have zero experience. How do you make money from stocks? But before we dive into how to start investing, let's first understand what a stock actually is. At its core, a stock is a piece of ownership in a company. When you buy a stock, you become a partial owner of that company. If the company grows and makes more money, your stock becomes more valuable. However, if the company struggles, the stock price can go down. There are two main ways to make money in the stock market. Number one, capital gains, profit from rising stock prices. This is the most common way people make money in the stock market. Capital gains happen when you buy a stock at a lower price and sell it at a higher price. For example, let's say you buy a share of Apple for $100. A few months or years later, the stock price rises to $150. If you sell it at this point, you've made a $50 profit per share. This price movement is driven by factors like company performance, industry trends, economic conditions, and even investor sentiment. Stocks of high-growth companies like Amazon, Tesla, and Nvidia have historically seen their prices skyrocket, making early investors huge returns. Number two, dividends, getting paid just for owning stocks. Some companies reward their investors by paying them dividends, a portion of their profits shared directly with shareholders. This means you earn money regularly, even if the stock price doesn't rise. For example, companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble have a long history of paying consistent dividends. Investors who own their stocks receive payments, sometimes quarterly, sometimes annually, just for holding the shares. Dividend investing can be a powerful way to build passive income, and studies show that dividend-paying stocks tend to outperform non-dividend stocks over the long run. According to a 2023 study by Ned Davis Research, companies that consistently paid and grew dividends outperformed the S&P 500 index by nearly 3% annually over the past 50 years. Now that you know how to profit from stocks, the question is, how do you pick the right stocks to invest in? Because while some stocks can make you rich, others can wipe out your money overnight. Let's find out. Types of stocks. Not all stocks are the same, and understanding the different types can help you build a strong investment strategy. Here are the most common categories and what they mean for investors. Blue chip stocks. Blue chip stocks belong to large, well-established companies with a long history of success. These are household names like Apple, Microsoft, and Amazon, known for their financial stability, strong leadership, and ability to withstand market downturns. Investors often choose blue chip stocks because they tend to be at lower risk compared to other stocks. While they may not offer the fastest growth, they provide steady returns over time. According to Investopedia, companies like Walmart and Johnson & Johnson are considered blue chip because of their consistent earnings and leadership in their industries. Growth stocks. High risk, high reward. Growth stocks are shares in companies that are expanding at an above-average rate. Companies like Tesla and Nvidia fall into this category because of their rapid innovation and increasing market demand. The appeal of growth stocks is their potential for significant gains, but they come with higher volatility. Unlike blue chip stocks, these companies often reinvest their profits into expansion rather than paying dividends. A 2023 Barron's report highlighted that while growth stocks have soared in recent years, they tend to be more sensitive to economic changes. Dividend stocks. Get paid while you invest. Dividend stocks belong to companies that distribute a portion of their profits to shareholders regularly. These payouts provide passive income, making them attractive to long-term investors. Coca-Cola, McDonald's, and Procter & Gamble are great examples of companies known for paying consistent dividends. According to Investopedia, dividend stocks are often from stable industries, meaning they can provide income even during economic downturns. Index funds and ETFs, the beginner-friendly approach. For those who find picking individual stocks overwhelming, index funds and exchange-traded funds, ETFs, offer a smart alternative. These are collections of stocks bundled together, spreading out risk. For example, investing in S&P 500 index fund means you're essentially buying shares in the 500 largest US companies. ETFs work similarly, but can be traded like individual stocks. Studies show that ETFs are a great option for beginners because they provide diversification without the need for constant stock picking. Now that you understand the different types of stocks, the question is, how do you actually start investing? What's the first step? How much money do you need? And what mistakes should you avoid? How to start investing, step by step. Step 1. Open a brokerage account. Before you can start investing, you'll need a brokerage account. This is like a bank account, but for buying and selling stocks. Brokerages act as the middleman between you and the stock market, giving you access to buy shares of companies. There are many brokerage platforms to choose from, including Fidelity, Vanguard, Charles Schwab, Robinhood, and E-Trade. Some cater to beginners with user-friendly interfaces and commission-free trades, while others offer advanced tools for experienced investors. Most brokerage accounts are free to open, and many allow you to start investing with as little as $1 thanks to fractional shares, where you can buy a piece of stock instead of a full share. When choosing a brokerage, consider the following. Fees. Some platforms charge trading fees, while others offer commission-free trades. Investment options. Does it offer stocks, ETFs, mutual funds, and other assets? User experience. Some apps, like Robinhood, have simple designs, while platforms like Vanguard are more traditional. Research tools. If you want to analyze stocks, platforms like Fidelity offer detailed reports. Once you pick one, sign up, verify your identity, and link your bank account to start investing. Step 2. Fund your account. Now that your brokerage account is set up, it's time to add money so you can start investing. The good news is that you don't need thousands of dollars to begin with. Many brokerages allow you to start with as little as $10 or even $1, thanks to fractional shares. This means you can start to invest in companies like Apple, Tesla, or Amazon without buying a full share. Choose a deposit amount. Start small if you're new. Many experts suggest investing what you can afford to leave untouched for a few years. Pro tip. Some brokerages offer sign-up bonuses where you get free stocks or cash just for depositing money. Look out for promotions when choosing a platform. Step 3. Choose your investment strategy. Long-term investing. This means buying stocks and holding onto them for years. This is how legendary investors like Warren Buffett make money. Dollar cost averaging. Instead of trying to time the market, invest a fixed amount every month. This way, you buy stocks at both high and low prices, reducing risk. Step 4. Buy your first stock. Pick a stock or ETF, press buy, and just like that, you're an investor. Now, before we wrap up, let's take a look at the most common mistakes beginners make. Even experienced investors make mistakes, but beginners are especially prone to a few common pitfalls. Avoiding these can help protect your money and set you up for long-term success. Trying to time the market. Many beginners believe they can predict the perfect moment to buy low and sell high. But the truth is, even experts can't consistently time the market. Instead of waiting for the perfect time, it's better to invest consistently using dollar cost averaging. This means investing a fixed amount regularly, no matter what the market is doing. Studies show this strategy reduces risk and smooths out market fluctuations over time. Not diversifying. Putting all your money into one stock is like betting everything on a single number in roulette. It's risky. If that company does well, great. But if it struggles, your entire investment takes a hit. Instead, spread out your money across multiple stocks or ETFs to lower your risk. A well-diversified portfolio is more stable and resilient during market downturns. Panic selling. Stock prices rise and fall, sometimes dramatically. Beginners often panic and sell when they see their investments drop in value. But history shows that markets recover. For example, during the 2008 financial crisis, the S&P 500 fell nearly 50%, but within a few years, it bounced back and continued growing. Selling out of fear locks in losses. Staying invested is usually the smarter move. Ignoring fees. Some brokerages charge high fees for trades or account management. Over time, these fees can eat into your profits. Stick with low-cost brokers and zero-commission trading platforms whenever possible. Investing without a plan. Jumping into the stock market without a clear goal can lead to impulsive decisions. Ask yourself, am I investing for long-term growth, passive income, or short-term gain? Having a strategy helps you stay focused and make smarter choices. Investing in stocks can be one of the most powerful ways to grow your wealth, but success comes from learning, staying patient, and making smart decisions. Now here's a question for you. What's one stock or ETF you're interested in investing in? Let us know in the comments below. If you found this video helpful, hit the like button, subscribe to our channel, and share this with anyone who's just getting started with investing. Thanks for watching, and we'll see you in the next video.